Okay, well, good afternoon. This is Ed Morales, Chief Marketing Innovation Officer for the Pinnacle Group, and welcome to another edition of Next Level Advisor. And specifically today, I'm very excited to have you have Scott McHenry, one of our strategic partners. He is the founder and chief actuary for McHenry and Associates, and essentially he is our go-to from a planning perspective across our distribution. So as it relates to tax planning and tax planning in the area of cash balance planning and so forth. And I'll let Scott talk more about it. Scott, welcome. It's good to see you, my friend. How are you?
I'm doing great. It's great to see you, Ed. Thanks for
Yeah,
having me today.
yeah, it's good to see you. And it's crazy. We're sitting here on January the 31st, and 2024 is off to the races. And to think that we're turning the corner on another month coming about tomorrow is pretty crazy. I mean, it's been fast and furious. So grateful to have you with us.
Yeah, thank you. Thanks.
So let's kind of dive into it. Tax planning, cash balance planning. Cash balance plans, are they similar or dissimilar to, other employer type sponsored retirement plans? Can you give the audience a semblance of what cash balance is and how that, how does that resonate with employers and with advisors?
Sure. Cash balance plans are tax qualified retirement plans like 401k, like profit sharing plans. They have a lot of tax benefits built into them. The company that sponsors the plan can make contributions, and those contributions are tax deductible for federal and, if applicable, state income tax purposes. Investments grow tax deferred, like most other assets in retirement plans. Really, the difference, the major difference, is just the level of contributions that closely held for-profit business owners can contribute, oftentimes 3, 4, 5, sometimes 10 times more to a cash balance plan than they could some other type of retirement plan like a 401k plan. So it's really taking the qualified plan concept and the tax benefits, which are great for all employees, and really dialing it up, making it very, very special and powerful for the closely held for-profit business owner or more high-income individuals.
Wow, and significant, if I heard you correctly, in some regards, even 10 times greater type of contribution compared to other kind of employer-sponsored retirement plan. That's a significant benefit. I mean, to make that kind of to have the availability to be able to do that, that's significant.
Yeah, and the other point is the plans can be flexible and scalable, right? So I can show very, very large contributions. A lot of times that makes sense. But more importantly is these are always custom designed, and we can always dial down the funding to what makes sense for the business owner based upon cash flow and tax planning, what they're hoping to accomplish.
So let's talk a little bit about that flexibility, because for a lot of employers and obviously for advisors alike, having flexibility, having options, sometimes, as you very well know, with most types of tax qualified planning, you have limitations as far as, how you exit from that. And so it can be a little convoluted, complicated. So you mentioned the word flexibility. Can you elaborate a little bit more about some of the flexibility that can be realized with a cash balance plan?
Sure. Cash balance plans are defined benefit plans. They're subject to an actuarial valuation. So every year there's a range of contributions that can be made that satisfy all IRS requirements on the plan, as well as, providing a maximum contribution that a business owner can contribute and deduct. And the business owner can contribute anywhere in between that kind of minimum and maximum. Beyond that, there's ways that we can manage the plans to build in even more flexibility, meaning it's a defined benefit plan. It has a plan document, right? But on a prospective basis, that plan document could always be amended to change what benefits are being earned in future years. And as, because of that, it can drive the range up and down. So while these plans allow large contributions and some of our clients want to make the maximum contribution year in and year out, we have a lot of clients that are in cyclical businesses where they have high income certain years and not as much other years. And we can manage that to allow them to really take advantage of large deductible contributions when they need and want it, and then dial down the funding in other years. The
Mhm.
important thing is just that we as actuaries kind of understand what they're hoping to accomplish.
Can an employer, can they have a cash balance plan along with a 401k plan and other plans? Like, is that permittable? Is it possible?
Yeah, absolutely. Oftentimes we can have a 401k profit sharing and a cash balance plan going at the same time.
Mm.
And if the business has rank and file W-2 employees, that's almost always the design. If we only have business owners and no other W-2 employees, oftentimes we can accomplish what we're hoping to accomplish just with a cash balance plan. But if there are other employees, we usually are going to have both a 401k and a cash balance plan going at the same time.
So going back to when you talked about defined benefit, obviously that's defining a specific benefit at a specific time in the future. So can you talk? Do cash balance plans provide opportunities for any form of guarantees or guarantee rates? Or curious to hear your take on that.
Yes, I mean a cash balance plan is first and foremost a defined benefit plan. It has a written plan document that indicates what the benefits are. It provides a lot more flexibility and some other benefits that make it more preferable today as compared to traditional defined benefit plans, meaning that we're defining the benefits based on a current lump sum, a current benefit allocation, if you will. But it does have some guarantees in there for rank and file employees, right? That
Mm.
they get an annual allocation plus a plan defined interest credit, right? So there is some more level of guarantee for rank and file employees, which is great. For the business owners, they're generally going to go into the plan just based on the higher level of contributions that can be made on their behalf, the immediate income tax savings, as well as the tax savings, on a going forward basis.
Mm. Scott, how about portability? I mean, you mentioned obviously the benefits to employees and the huge benefit to the employer as far as their ability to contribute. And certainly it has an end in mind as per se. And portability, is that something that's available? Are there any unique options or availability to exit the plan at a certain time in the future? How does that work?
Yeah, absolutely. They're tax qualified plans, and they're going to allow a rollover to an IRA to another qualified plan, without a tax consequence when the individual is eligible for distribution.
Hmm.
Um, you know, Oftentimes at age 59 and a half, or when someone terminates employment, they're eligible for distribution. Beyond that, from the plan sponsor level, usually at the plans are set up, allow a high level of contribution, but at some point in time, the cash balance plan will accomplish all that the business owner wanted it to, or it hits ultimate limits of what can roll over to an IRA. So oftentimes we'll terminate a pension plan after it's done all that it can do, and still the business owner can roll over those assets that have been accumulated into an IRA. There are occasions where some, um, where some pension plans will even include life insurance, and so sometimes life insurance can be funded inside of the pension plan, but later, is portable out to personal ownership or grantor trust, depending upon what the uh, business owner key individual is hoping to accomplish.
So you mentioned life insurance in as part of potentially one of the vehicles or a component of the actual cash balance plan. Are there does that enhance or does that actually affect the contribution rate? Does it allow for greater or less contribution because of that? I'm just curious just to hear that through.
Yeah, it's first and foremost, it's an option, right? There are a lot of pension plans out there that are traditional investment only cash balance plans. Life insurance, if it's added, right, does increase what can be contributed to the plan, because
Oh,
now the plan is not only funding a retirement benefit, right, subject to some limits, but is also funding an ancillary death benefit above and beyond the retirement benefit,
Mm.
right? So just conceptually, I'm now funding for two benefits, not one. That allows me to fund and deduct a larger contribution. Um, yeah, and beyond that, sometimes it gives some, it protects the family in the event of a premature passing,
Hmm.
right? But it also gives, I think the individual some flexibility on the back end, right? Because a lot of cash balance plan participants, business owners will fund a lot into these plans, right, and end up with a large IRA. But there's also a way where life insurance can be portable out of the plan into personal ownership or grantor trust. And now I've also funded something that can give me some flexibility on the back end, right, of how I use it and potentially some tax benefits on the back end.
So life insurance could lend towards giving you increased flexibility, more options, and in some regard, listening to you, almost self-completing in regards to some of the needs that a business owner may have. So,
Yeah,
um,
absolutely.
yeah, what do you see? It's interesting when you cash balance. Like who are potential business owners that this really would resonate with? What would be that? And really looking, and looking at the listening audience right now, what would they look for? And who qualifies, and who would be the optimal business owner to consider this type of planning for their business?
Sure. I would say a closely held business owner, right? So it works great for an individual that owns 100% of an operating company, or three, four, five partners, right? A pretty closely held group. Um, High income, and they want to pay less in current income tax, right? You check those two boxes, and I think it's worth exploring.
Hmm.
Oftentimes, we'll say, it's the individual that wants to contribute 100,000 annually or more, towards their retirement. Um, because with a SEP or a 401k profit sharing plan, oftentimes they can contribute 60,000 plus, right? So we want somebody that wants to do more than they can in a 401k plan. Other than that, I see all sorts of industries. Probably 30% of our client base are professional service firms, medical, dental, law firms, investment advisors, CPA firms. About 30% are owner only companies. So think of someone that has 1099 income that may not have any of their own W 2 employees. So commercial or residential real estate agents often fit that profile. Individuals that may have side income, right? So they're a W 2 employee of a large organization, but separately they have some other 1099 income for consulting, serving on board of directors. And then the bulk of our clients, the remaining 40%, are family owned, closely held businesses of all different sorts of industries. So construction, manufacturing, agriculture businesses, um, consulting firms of all different types.
Yeah. So I know we're sitting here. It's January 31st. We're certainly in a new year, and for a lot of members of the that are listening here, is it too late to consider a cash balance plan for possibly for 2023 for business owners? I know that depending on their status, it could be March 15th, it could be April 15th. I'm kind of
Yeah.
curious. I mean, for that audience out there that may be looking for that enhanced tax deduction and having benefits for themselves and their key employees or employees in general. Is it too late? Is it or for that last year? I'm just curious.
No, not at all. And this was actually a relatively recent law change, part of the original Secure Act. We can adopt qualified plans, including cash balance plans, up to the due date of the business tax return. So no matter how the business is taxed, C corp, S corp, sole proprietor, Schedule C sole proprietorship, all of them would have up until their original due date. And if they extend their tax return all the way up until September 15th of 2024, where we potentially could set up a cash balance plan, they fund it, and is tax deductible for all purposes for the 2023 tax year. So
Wow.
we've started calling it the tax mulligan. For any golfers out there, it's a way to have a do over on your 2023 income taxes.
Yeah. So, so Scott, how do you get started? How would in its very simple 1, 2, 3 steps or whatever you may have? How does one get started with that? To really look at whether obviously eligibility, and so I'm just curious. I think it'd be helpful for the audience to know. Here are the steps to take to move forward, to be able to actually consider the implementation of one.
Sure. We have what we call starter kits, which provide some basic information on cash balance plans, kind of show what could be possible, and then have some basic forms as far as information that we would like to see. To put forth an illustration of what may be possible for a business. And I think any of any listener's Pinnacle contact, could get that to them, and I know Tom Worthington, is kind of your specialist for cash balance plans.
Right.
Beyond that, once information is provided to us on a business owner, including a little bit about their business, and then the employee census, who the employees are, dates of birth, dates of hire, compensation. Then we put together a feasibility study, a plan design illustration that kind of shows what's possible, right? How much in contributions can the business owners make on their own behalf? What does the contribution structure look like for employees?
Mm-hmm.
And then we're always happy to review that, right? To adjust it so that the plan ultimately fits, what the business owners are hoping to accomplish.
Yeah, it doesn't sound like it's an elongated process here. It seems like, correct me if I'm wrong, but it doesn't seem elongated nor tedious. It seems like the process wouldn't take that long. Am I correct in hearing that?
It doesn't have to. It's with information, it takes us a week to kind of put together a feasibility study.
Wow.
That can be presented and adjusted as necessary. And if someone wants to go ahead, within a week after that, we could have a written plan document. They could get a tax ID number for the plan and set up investment accounts and start funding the plan. So it can be really quick. A lot of times, there takes a little bit of time for someone to decide what level they want to fund and if it makes sense for them. But it can be done pretty rapidly.
That's excellent. That's excellent. Scott, listen, I thank you. The information I think is invaluable, and I think for a listening audience, I mean, this is a tremendous opportunity. I know a lot of businesses are always looking for where they can actually develop better efficiencies and get tax deductions, and also do well by some of their employees, and of course for themselves, especially as you mentioned, they're the high income earner within that business. So, Scott, I want to thank you. I know that we'll be talking again in the very near future, but look forward to talking again. And thank you for your time today.
Great. Thanks for having me, Ed.
Yeah, appreciate it. Thank you.